I'm a real estate agent here in Scottsdale. I'm with Platinum Living Realty. I've been with them almost a year. I've been licensed over 6 years now, and I've been investing since the housing market crash of 2009. So I kind of, after several years, I realized, wait a minute, people don't get the right help, I guess you could say. I always used who my mom always used, and I just kind of realized that there's so much more that they should and could be doing for me. And so I decided to get licensed, and because I knew I could do it better. And that's always my goal, is take care of my tribe, protect everybody, protect their assets. Because for most people, their home is their largest asset. So I want to make sure that that gets my full attention every time, and that I'm not just kind of being flippant about it. Like, yeah, whatever, you know. A lot of agents get into it because they think it's an easy paycheck. And then those agents end up not caring about their clients enough. And then they make the rest of us look bad. So I spend a lot of time trying to be of service to my clients. So whether that's making sure they have toilet paper this week, so that's kind of where my focus is.
So I am a insurance agent with Farmers Insurance. I've been doing this 17 years. So since I was 5, my focus is personal lines and commercial, though we do life insurance as well. We're a family agency, so we've been in business 32 years now. When my mother-in-law retires, I will take over the running of the agency, and we love what we do. We're very passionate about making sure people have the right protection. We want to cover the things that are going to ruin your life, not ruin your day. So that's what I do. My passion is just educating people about what their insurance needs are. What they do need, what they don't need, what they can do without, and what the best path forward for them protecting their future is.
I am Ted Canto, loan officer extraordinaire.
Loan officer extraordinaire.
I was just in a room full of loan officers. We were just talking about all the crazy stuff that is happening. Geez, every day is something else. It's like ding, ding, just taking beatings like every day.
Yeah.
Oh.
So Ted, this is my best friend Amber. She owns an insurance agency down in Tucson.
Hey, Amber.
Hey, Ted.
And so why don't we just jump into it now? It's 4:10. So Ted, let's start with you. Are interest rates low right now?
Well, actually, it's all relative.
Relative.
So, wow, you did this on purpose.
Yeah.
She'll get me later. It's okay.
It's such a complicated answer, and she's heard it from me, so she knows. That's why I'm not so happy with
you
her.
And every other loan officer from here to New York.
Oh, so it's all relative, yes and no. So depending if you're trying to refinance, it's much tougher. Rates are definitely higher or more costly. What the market is doing. Let's just stick with refis for a second, because it does really go all over the place. With refis, the market is forcing lenders to cap what rate is available. So they're putting a ceiling on it because they're afraid that if they go too high, then it's an easy target for an early payoff, which would cost thousands of dollars in losses for that one loan. So they're putting a ceiling on certain loans, or on the interest rate. Then depending on what you're trying to do and who you are, your credit score, are you trying to take cash out? Are you trying to just do a rate and term, so on and so on, then would determine the pricing of that rate. So let's just say the cap today is 3.6. Depending on what you're trying to do, it may cost you a couple of points. A couple of points, it's that bad. Or, well, no, it's going to be always a couple of points. It's going to either be 2 to 4 points, depending on what you're trying to do. That's on a refi. And then VAs are not so bad, but some of that's happening there. Now, the other thing with Govy loans, VAs and FHAs, the market is really retreating back from government-backed loans right now. I don't know why. I'm still trying to wrap my head around it. But if you're FHA or VA, a lot of lenders are now hiking up the credit requirement. So they're not going below 620 anymore. And some of them are even putting a floor of 640. So if you don't have a 640 or above, no loan for you. That's happening across the board, whether it's purchase or refinance. I haven't seen it quite yet, but it's supposedly coming down the pipeline.
What about conventional loans?
The other like 3.625, that was conventional. So on purchases, they're definitely giving a little bit more love on the pricing. So you're still looking at probably, depending who you are, somewhere between 3.6, maybe 3.8 on conventional purchases. The priority is definitely leaning towards purchases. A lot of lenders right now are refraining from refinances for a lot of reasons, because this is where it gets complicated. Because with all of the technical factors, if we were to look at all the technical graphs and everything else, these things would tell us that rates should technically be about like 2.25. They're not even close. So I think what's happening is, based on what I'm listening or hearing and learning, is that they're not willing to go too high on those rates, because obviously early payoffs, same time there's not enough people in the market for those lower rates. The coupon's not quite there, and the liquidity. So I mean, it gets really complicated. I'm just trying to give some bullet points, but it's a mess. Let's just put it that way.
What about jumbo loans? Can you define what a jumbo loan is and what's going on there?
Yeah, definitely. A jumbo loan is basically, one second. Somebody's on my team is reaching out to me, so give me 1 second. All right. So a jumbo loan is anything above the loan amount of $510,400. So I guess technically speaking, you could be at $510,401 and be considered a jumbo. So anything above that's a jumbo. The market has definitely retreated from jumbos. Right now, the pricing is horrible. I priced somebody out yesterday, and it was something ridiculous, like 3%, like 3 points. And that's before anyone gets paid. That was the cost of that loan. So it was ridiculous. It was like an $800,000 loan. Do the math, 4%, $32,000 just in discount, let alone, before the lender makes any money, and then the closing costs. So in other words, the bank's basically saying, go away. That's really what they're trying to say to you.
Right. So in other words, and I talked to a lot of other lenders like around the country and locally, and they were all kind of saying the same thing. The one caveat I found was the big banks that nobody likes to deal with, we're still offering them.
Yeah, definitely. There's, I was just on a Zoom meeting with a bunch of loan officers, and one of them works for a depository lender. So in other words, they do loans and they keep them and service them. His pricing was phenomenal, but he's definitely one of the more big box lenders. So, however, that may come to an end at any given moment as well. So who knows? But right now, as we're speaking, some of the big box lenders, they're able to do things that most mortgage lenders aren't able to do. So
perfect.
Yeah, but you're talking about the Chases and all that other stuff. So
those who shall not be named.
Yeah, those who shall not be named, exactly.
Some of those big boxes have recorded versions of me saying, "This is why no one likes you." Anyway, so Amber, how has things been going, like insurance wise? Like, what are you dealing with? How have things changed for you?
So I think a lot of what we're seeing right now is the calm before the storm. Our personal lines clients, so our traditional auto, home, life, we're just reaching out to them and reassuring them that our office is functioning and operational. We're farmers and we're a national corporation, but each agency is individually owned, and we're a family agency. So we operate by our own rules. So we're reaching out to let people know that, your personal agent is still here for you. We're not a 1-800 number. On our commercial policy side of what we're seeing a lot of is restaurant owners with the ordinances that have been passed with the city and the state of, them having to shut down. They're having to lay off employees. If they can operate on a takeout basis, it really just depends on the type of restaurant they are. We've got 5-star dining restaurants that nobody's going to go order a veal to go. So they're struggling the most. They've got inventory that they have, that they need to make sure isn't going to spoil. They've got employees they're laying off. The smaller restaurants or the fast food, they're doing okay because they can just close their lobby. There's a lot of people are wondering, is there coverage for this? Is there something that's going to help me? And in most cases, unfortunately, for something like this, because it's closed because of a virus, there's really no additional assistance. So that's kind of what we're facing right now with our commercial policies. Not really with like retail storefronts. A lot of them are still operating. They're, under Governor Ducey's guideline, they're considered essential services. So they're fine. But I really think it's for our personal lines clients, it's the calm before the storm right now.
Okay. So say somebody just lost their job. They don't have some kind of like Aflac broke my leg type insurance or whatever to cover that. Right. What can they do to reduce their bill without losing their coverage? Right.
At this point, I really wouldn't advise anybody to make any drastic changes to their insurance. We saw this with the recession years ago, is that people panicked and they would start cutting coverage. But really, insurance is there to protect your assets. And if you've got a $500,000 house in the foothills and all of a sudden you want to drop your insurance down to what's required by the state, which is $15,000 per person and $30,000 per occurrence, that hasn't been updated since the Nixon era. You can't hit a car and cover that out of your pocket, or, your insurance isn't going to cover that. So we saw a lot of that and people getting nailed in lawsuits because they would drop their coverage. What we're really advising people now is, especially with our clients, is pick up the phone, call your personal agent and ask what you can do. Because a lot of times there's discounts out there that people aren't taking advantage of. Farmers has tons of discounts for occupations, from veterinarians to engineers to pilots. There's tons of different discounts that people don't take advantage of. There's a discount that can save people up to 25% if they have a youthful driver in the household. And I've had that conversation with a few people who are starting to, they're worried. Nothing has negatively impacted them yet, but they are concerned about the future. And we're trying our best to advise them of different ways that we can help them save money without losing that coverage that really they need.
Okay, cool. So I'm going to do a rapid fire kind of thing. And I'm just going to give you some things and I'm going to ask you, is it covered? And I want you to say yes or no and try to keep a straight face. Take a drink. I'm going to need it. All right. So are pandemics covered?
No.
Are zombies covered? Yes or no? Could you get coverage on a zombie?
The ammo you use to shoot the zombies covered.
Okay, I'll take it. Riots.
Covered.
Natural disasters?
Depends on the natural disaster.
Ooh, what's not covered?
Flood.
All right. What if the zombies are rioting?
That's the least of your problems, is your insurance.
All right, I'll take it. I had a quick question, and then it evaded me.
Kind of like those rioting zombies.
What are you going to do? I was promised zombies in a pandemic.
This is not the apocalypse I was promised.
No, I'm really let down. Anyway, so all right, so going looking at my notes. Ted, I'm going to share my screen, and Ted, you can jump in. What I'm finding with real estate, it started last weekend, like Friday evening, I started getting call after call after call off of Zillow, and I advertise in several places, but all of a sudden Zillow was blowing up and I was getting raw land calls. Like, I do raw land, but it's not like the mainstay. That's not like where all of my focus is. And I thought it was interesting. One was even a group of young guys. They were looking for a huge piece of property that they could split because they're going to buy one, build 3 houses, and have their own little compound. It was like
It's landmines?
I didn't ask, but they sounded like the 25-year-old version of us. So,
I like them.
So I thought that was interesting because it seems like people are like just heading for the hills and want to have their own compound. And the other thing I noticed was that a lot of people, like Ted kind of touched on, were assuming that rates had stayed low because the rates went low. And then everybody had that firestorm, and then there was a pandemic, and then everybody forgot about what was happening to the rates in the midst of all that. So I've been finding that trying to like educate people. I found people panicked and like pulled out of contracts for like no reason other than like the sky is falling. They had like no statistical like data to go on. They're just like, the sky is falling, we're going to have a recession. And I think people get hung up forgetting what a recession really is versus what we had last time, which was an anomaly. So it allowed some of my buyers to pick things up at a little smidge of a lower rate price wise. Because somebody else like freaked out. And then we had those 3 or 4 days, everybody was locked down or hunting for toilet paper and it was raining. So nobody was looking at homes. So I was showing homes in the rain while everybody else was worrying about toilet paper, and those buyers were able to pick things up. So the serious buyers are still out there. But I'm going to share my screen here real quick. So I put together some stuff.
Hey, Dusty, if you don't mind, let me jump in real quick while you're doing that.
Okay.
For those that are watching, what a lot of people don't understand is they're taking some of this banking situation and they're attributing it to the virus. What they don't know is that this has already been happening. This has already been something that's been in the works, if you will. And that's a bad statement, but I guess it's been crumbling for the last probably 5 to 7 months. What ended up happening during that small pocket, which is really only 72 hours of low rates, was that everybody rushed into the door, took their toilet paper. I've been using that analogy a lot. And then basically the banks ran out of money or the store ran out of toilet paper. So now what? What do we sell it? Now it gets complicated, but there's been a liquidity problem coming down the pipe for a long time now. It just happened to be, though, that the virus came along and just made that problem that much bigger. So just want to kind of give some context to what's happening.
Exactly. So like the main issue now is just liquidity and availability of the funds. It's coming. It's just going to be slow. So people keep likening like a recession to a total housing collapse. And for those of you who don't know, I'm married to our former state treasurer, Dusti Martin, who predicted the last recession. And he, of all people, was on the 5 o'clock news saying, hey, we're going to run out of money on April 15th. You better put some away. And our then governor, Napolitano, called him, literally went on the news, called him Chicken Little and said, don't worry, everything's fine. And then what do you know? Like the state almost lost its capital. We almost had to sell it to China. And a bunch of other stuff went down. And so he was able to like guide the state and the state trust, state land trust out of that and still made money in the recession because of that. But the key is to like understand like what is a recession, and people need to remember it's just a reduction in GDP for 2 consecutive quarters. So here we are almost to quarter 2. So we're still in quarter 1, right, Ted?
Yeah.
I can't remember what day it is.
For another 5 days.
Yeah. And so most people, and if you go back and watch any of my videos over the last year or so, got somebody, somebody's popping in on the chat. I'm still trying to learn this. But
It's me.
Huh?
It's me.
Oh, I can't see what you're doing because I'm
just trying to make sure that you're checking about people trying to join.
Oh, well, I can't really see, but anyway, so I'll just go from there. But basically, people keep forgetting that recession is not like the housing crisis. Like, it's just 2 quarters, and most experts are predicting that it's going to start to lighten up at the end of Q2, or maybe because of the virus stuff, Q3, but then they think Q4 will be back and roaring, which is good. That's a temporary normal dip. But if you go back through my videos, I've been talking about, we are overdue for a recession/correction. And so like, I'm going to put a montage together, see how many times I've said it in the last year. But now that it's here, we need to not freak out about it. So it's like, you see the storm coming and, you do nothing until it gets here, and then you freak out about it. So key is a recession doesn't equal a housing crisis. The last time around, the housing crisis caused the recession. So I think that's what people need to remember mostly. But with that being said, 3 out of the last 5 recessions, housing prices actually went up. Homes appreciated. So people need to remember that. Only in like 1991, here's Allison. Oh, there we go. Admit. But so that's the thing to keep in mind, is a housing crisis is not necessarily like recession doesn't equal housing crisis. Housing crisis doesn't equal recession. So Ted, do you want to add anything to that?
Also adding to the history of recessions, aside from I call it the crash, because it really, as you alluded to, it wasn't really a recession in the traditional sense. For every recession, I think for the last, probably 70 years, it's been that for every one person that loses a job, 3 home buyers enter the market. In other words, three families buy a home.
Wow.
Yeah.
That's a cool statistic. I did not know that.
Yeah.
There we go. All right. So people keep asking, like, is this recession more like the Great Recession that we just had in 2008, or is it more like 9/11? So Steve Harney from Keeping Current Matters, they call him the Oracle of Real Estate. And his economists and the people he watches basically said, no, this is more of an event, a dip, where you're going to have like a V-shaped kind of correction, not like the way me and Dean usually explain how we had the 2008 recession with the Nike swoosh, which is basically we had this huge drop down and then we had this long, trail, hard climb out of it. So when you think of it like that, when you have an event, a pandemic, terrorism, whatever, you get this V, you get this immediate drop, and then when things go back to normal, it shoots back up again, and it ends up being a really short-term event. So what 9/11 had in common with what's happening now is that it was a shock, and it generated fear and angst and anxiety in the general public. So people avoided crowds because they thought another attack was coming. Now it's go ahead. Oh, okay. I'll just keep talking. So, today people are doing the same thing, but it's because they're wanting to avoid getting sick or getting someone in their family sick. So it's the same parts of the economy that are under pressure. So it's airlines, leisure, hospitality, restaurants, entertainment, consumer discretionary services in general, meaning it's not something people really need. And then in the stock market, like the other question is people see the stock market tanking and they think, well, that's going to happen in the housing market. And unfortunately, the housing market is not always a reflection of the stock market. Did I say that right? The stock market is not a reflection of the housing market. The housing market is not always a reflection of the stock market. But anyway, so like in 91 and at 9/11, when the S&P crashed from 2000 to 2002, it went down 45%, but the whole annual, like the home appreciation over the same amount of time went up 20% or a little more. So you have to remember, like, yeah, we had a big correction in the stock market, but housing prices still went up. So, like, Ted, do you want to add anything to that, or?
No, I mean, it's right on. I mean, your point is, in a nutshell, people freak out because it was a traumatic experience. So I'll just put some context or maybe some banter into this conversation. But 2008 was very traumatic for a lot of people. It was traumatic for our family. I mean, we were a casualty of it all. So it became almost, for most people today, it becomes the benchmark of what a recession looks like. And it's not real. That's not correct, I should say. 2008 was not, again, a recession in the way that we've known it historically. So, everything that you're hitting upon is actually correct. What some people are having a hard time with is that when they see these numbers or they hear, like, prices go up or more families go into the purchase of a home during recession, it's hard for people it's hard for that to sink in because, again, they revert back to 2008. It was such it was a dark period for a lot of families. So I get it, but it's not the traditional recession. And it's very foreign.
All right, cool. So let me see here, go to the next one. So people keep asking me, like, well, how do you know this is different? And Steve Harney is amazing. He put together most of these slides and stuff and made them available. But he breaks it down much easier than I can because I get stuck in the weeds and my inner nerd comes out. But basically, during the last housing bubble, it was hard not to get a loan. If you could fog a mirror and said, yeah, I happen to make, XYZ amount and I'm a millionaire in my off time, they would give you a loan. And so today things are much different. So if you look at this, it's much harder to qualify now. In fact, Ted just said, if anything, they just raised the standards because of all this. And so the summary measure indicates that the availability of the mortgage credit, the availability index is just a snapshot of the availability at that point in time. So the higher the index, the easier it is to get a mortgage. And then if you look at the graph, this is, I don't know if you guys can see my mouse, but down here, June 2006, they were like, yay, loans for everybody. Everybody gets a loan. Everybody gets 4 loans. Let's do this. And then you had, the backslide, this huge drop off, and it's a little more like the Nike swoosh. But this is, today down here, this is, they tightened up regulations so much, and I could get into like all the politics of the Dodd-Frank, Barney Frank, all of that stuff on why it happened and stuff, but that doesn't matter. What happened is they tightened up all the regulations because the bank said, hey, if you don't want us to loan to people who shouldn't have loans, let us tighten it back up. So they did, and they really haven't wavered too much from that since then in the last, 10, 12 years. Yeah. So that's one thing to keep in mind. The other thing, which is different, is that prices aren't out of control. The 6 years before the housing crash, prices were like crazy. Like they would go in 2000, they went up 8.6%, then 6.5, then 8.5, 8.7, and then 2004, 12.5 in 1 year. And then 11.4 in 2005. And then 2006 is when like warning signals started happening, and the smart people in the economic industry were like, hey guys, this isn't sustainable. Let's chill out. But when you look at the last 6 years before now, we've had more stable growth. Yeah, it's been a little better than we were used to, especially coming out of like such a long, hard climb. But stable growth is like 3.6%. So yeah, we're a little elevated, but I think it's because so many more people are back to work in a better spot financially. They learned their lesson. They got burned. They're not going to do it again. They, have been more reasonable with their investments and their financial stuff. Amber, how many drinks have you had?
Counting.
Oh, well, it'd be fun if we counted and see how much
bottles at my feet.
Wait, hold on a second. You guys are drinking?
Yep.
It's happy hour.
Dang right.
God.
That's why I didn't want to be on camera. I've got mine too.
But,
Kim, did you pick up the cotton candy vodka?
No, I would have been in form.
Yep, it's 1:30.
I didn't put beer emojis in the message for nothing, Ted.
That's true.
I said grab a cold drink. What you grab is up to you.
Innocent old me grabs this.
Read between the lines.
Amateur.
So, and then the next thing that I thought was really interesting when I saw this stuff is that we don't have a surplus of homes. And I've been like screaming this for a couple of years now. We don't have enough homes. People aren't selling their homes. I have tons of buyers. You guys have probably seen my video of all my buyers in waiting, basically looking for the right thing to come along. In fact, there's some people on this call I know are looking for something very specific and it's not out there. So they're just waiting for it to come on. So, so if you look at this in 2007, there was an 8.2% or 8.2 month of supply. So for those of you who haven't seen my monthly market videos, you would know that 4 months or less is seller's market. 4 to 7 is kind of even stable market. And then anything over 8 is a buyer's market. So in 2007, all these people were getting on the train like, yeah, I'm going to sell my house. I'm going to be a flipper. HGTV was convincing everybody that they could be a home flipper too. And is Lisa laughing at me? Isa's my sister-in-law, everybody, just so you know. She's probably drinking too.
She's married to your brother. She's drinking.
Yeah, she muted herself. But anyway, so when you can see that, like when you think about it, like all the warning signs in 2008 were there and people were just being stupidly emotional in terms of thinking that, no, this is great. It's going to happen, like go on forever. And I'm sorry, that's not how markets work. What goes up must come down. What goes down must eventually go back up. So in 2007, we had 8.2 months supply, but today the national average is 3.1, which is like solidly in a seller's market. So, I mean, it's not like parts of the valley.
I don't know any house in Tucson that is on the market longer than 30 days.
Yeah,
I mean,
and if it is, it's priced wrong and marketed horribly. Yeah. Fun fact, in Arizona, 33% of all properties still are not selling.
Why?
Because they're overpriced and marketed really badly.
Okay.
So basically, if the house didn't sell, it's because the agent didn't do their job or the price was really inappropriate or both. And in most cases, when I go back through and I look at expireds and canceled, it's usually both. Because a lot of agents will take a listing, they'll pay the owner lip service and say, yeah, I can sell your house for $600,000 when it's really like a $450,000 house. So, I mean, when you have a seller's market, say it's like 3 months, like the graph shows here, you can have a gentle upward pressure from where the comps were. And this is why like it pisses me off when I hear agents talk about the comps. The comps don't matter. They don't matter at all because the comps happened yesterday based on the supply and demand yesterday. The comps are only good in relevance to the supply and the demand. So if you don't know your month's supply, you don't know if you should price above the comps, right in line with the comps, or under the comps. And so, yeah, like when my inner nerd comes out, it gets really, really angry. And it's usually angry with other agents who don't know what they're doing, and they just rely on what happened yesterday. Yesterday is not today. So, for example, I work mostly North Valley in Phoenix, usually from about Shea North. And what I find, like in most of the North Valley, there's only about a 1 month supply. In some neighborhoods and in some zip codes, there's less than a 1 month supply. So in 85028 this past month, for February, they had like a quarter, like 0.27 or something ridiculous. And basically every home in that zip code, if no new homes came on the market, would be gone in 2 weeks. Maybe.
Wow.
And it's because like so many people are coming here from other places with higher taxes that are cold and miserable. And then they come here and the taxes are lower and the houses cost less. So we have this huge influx of people, but then people have also recovered from the last recession. So they're doing better financially. And most people made that mistake last time. They got a great rate, somewhere in the bottom of the market, or they got a great price on a house. So they're not willing to give that up, especially when they look at the market and they see there's nothing on the market that meets their fancy. So a lot of people aren't selling because there's nothing out there for them to go buy. So I have a lot of sellers.
That's where I'm at.
Yeah, I have like a lot of sellers in every single price range. I have $1 million sellers. I have $260,000 sellers, and none of them want to budge because there's nothing on the market that makes them feel like it's worth it.
Amber, are you looking?
Go ahead.
No, I mean, honestly, what it comes down to is what I pay my house, what I could sell it for, I'm just going to move into my house. There's no point. I mean, really, I've doubled my profit on my house, but if I sell it, I'm just going to move into the same house. So I'll just stay here.
Oh, you like your house?
I love my house.
All right. Well, that makes a difference. Can I ask a question about
Sure.
California? My sister lives there. And
I'm sorry.
Just what's with the influx of California? Are they moving here for investments or to live, or both?
Both. I probably get at least 2 phone calls a month from investors in California because they did more rent control measures in California and basically made it impossible to buy up an apartment complex that was old and ugly and had a low cap rate. And then they would come in, they would flip it, basically, systematically go in and update the units and then charge a higher rent. That's where they get their money. And then they would either buy and hold and flip over time, or buy, flip it, sell it. And now they can't do that. So that, coupled with the fact that their tax rates are ridiculously high. I mean, we're talking over 50% for most average to high income earners.
You're talking California tax.
Say that again?
You're talking California tax.
Yeah,
right?
Their income tax and their corporate tax rates are through the roof.
Right.
There's less jobs. I have some friends who are agents in California, and the majority of their business is listing homes for people who are leaving and coming to like Arizona or Texas or another low tax, low cost of living state.
Got you.
Can't take it anymore.
Well, and I grew up in California. I mean, I lived there for the first 13 years of my life, and my family moved to Arizona because even however many years ago that was, there was no home. They couldn't buy a home. They made $100,000 a year a long time ago and couldn't afford to buy a home because the homeowner rate was just, to buy a house, even today, you buy a 1,300 square foot house and it's upwards of $500,000.
Right.
It's insane. If I pick up my house and I move it to a decent neighborhood in California, I would pay $500,000 for it. It's insane.
Or for example, in 2010, when I bought this house at the very bottom of the market, my cousin in San Jose, Santa Clara, Silicon Valley. He also bought a home. He paid $479, and my house in Scottsdale here was on 2.5 acres, 4 bedrooms, 3.5 bath, 2,800 square foot, and a 6-car garage. He paid more, and he got an 1,100 square foot, 3-bedroom, 2-bath house that was over 100 years old in a really rough neighborhood with really rough schools. And it's been like that for a long time. So now if you wanted to buy his house today, it'd probably be $1 million, and you'd be in a really seedy area.
Wow. Yeah, I know. It's crazy, right? I mean, who wants to live like that?
Right. I told him you should move here. A lot of tech companies are moving here because of that.
You're working remotely. You're working like you guys are talking right now. This is it.
Yeah. This is how my brother and my husband work every day. This is how I work every day. But anyway, so the other thing, which I thought was cool, and I was kind of okay, I won't say it's cool, because I know there's people who are like, house prices have gone up, I can't afford to move, and they worry about affordability. But in comparison to 2006, homes are more affordable today than they were then. So especially like in terms of interest rates. So there's 3 components to that. So part of it's the price of the home. The other part's the wages that are earned by the purchaser. And then there's the mortgage rate that's available at the time. So all those things, when they combined, determine how much you can really afford. And then 14 years ago, prices were high, wages were low, and then mortgage rates were over 6%. And so when one little shift in the economy, and everybody gets on the bandwagon and dumps their house on the market, it was a disaster. But today prices are still high, but wages have increased, and the mortgage rate roughly is about 3.5%. So that means that the average family pays less for their monthly income towards their mortgage payment than they did back then. And then you can see what's this? This is the percent of the median income needed to purchase. So today you only really need about 15.5%, where back then you needed over 1/4% of your income. And then this is the slide that I thought was coming, but this is the one that made me kind of proud of Americans, and it gave me hope that they learned their lesson from all the stupid shit they did in 2008.
No, now we're just doing other stupid shit.
Yeah, we were, technically. We were still in college. But, or no, you weren't. I was. I took my sweet time. But in the run-up to the housing bubble, people were getting super stupid, and I mean super stupid, and leveraging their homes and using it like an ATM. And so a bunch of people immediately withdrew their equity once it built up, and then the market crashed, and then all of a sudden they owed double what their home was worth, mostly because they were stupid enough to leverage their home. So it wasn't bad enough to have one line of credit or a debt, which is the mortgage over their head. They had 2. And then
clients who had 3.
Yeah. It was, which I don't even know why a bank would do that. That's just stupid. But anyway, so prices have risen over the last few years, and leading to over 50% of the homes in the country having more than 50% equity, which is great. But the owners haven't been tapping it out like the last time. So in this table, you can compare the equity withdrawal over the last 3 years compared to 2005, 6, and 7. Then in 2005, they had withdrawn $263 billion. 2006 was 321, and then 2007 was 240, for a total of $824 billion. And then now, it's less than half that they've pulled out of their equity. It's very rare for somebody to pull out that much equity on their house and then go blow it on stupid stuff and over leverage themselves. So during the crash, when housing prices started to go down and the home values fell, people found themselves with negative equity. And so they figured, why am I still paying on a house that isn't worth, even if I paid it off today, which was kind of dumb to do. And so they just walked away. And we can discuss the merits, like whether they had a good job or not, they just walked away. And that's the other thing people should remember, is that real estate is a long-term investment for 99.9% of people. Like, not everybody's a flipper. Flips are rare, and you don't make that much on them. So please, for the love of God, like,
I mean, HGTV lies?
They do a lot. Anyway, so, but that's kind of where we're at. And then that's kind of, let me stop that. So anyway, so with that said, but anyway, Ted, do you want to add anything to that? He's like,
I put myself on mute. Well, all I kept thinking when you were talking to me, I was reading, as I warned in the beginning, I just started seeing memos pop up and on my screen. So lenders are definitely taking some more precaution as to what they're going to be lending out and how they're going to be lending out. So those numbers, how those numbers drop down, I think that's an indicator of where the banks are going, because that's the trend. Because right now they officially made it 640, as I'm reading on the screen, and at the same time, I think they're going to start taking a little bit more harder stance on cash outs as well. So people trying to leverage their equity, they're going to start taking. I don't think it's going to stop, but I don't think it's going to be very lenient, to say the least. So it's already starting. So so the grapevine was correct. One of the biggest mortgage lenders, Caliber, they're definitely rolled it out. So they're one of the leaders. So I'm sure that there's going to be a lot of people following their lead.
Does anybody have any questions before we call it quits? Because it's been almost an hour.
No, it's been really, really informative. I really enjoyed this.
Do you want me to talk a little bit about SBA?
Oh yeah, I totally forgot.
Okay.
So Ted, why don't you explain what those are?
So the SBA is the Small Business Administration. It's federal guaranteed loan for businesses, and it's it's kind of like the FHA of commercial property and businesses. So anyhow, before the stimulus package, they had taken what they call the disaster relief loan, and they lifted up they took off the roof on that program. So that program was specifically designed for businesses that suffered any damages during, hurricanes, tornadoes, floods, you name it, earthquakes. And so they made the COVID-19 part of that disaster relief. So any state, which is pretty much the whole country, businesses are now eligible to apply for that program. That program will easily grant up to $2 million to an LLC or a type of small business to sustain their business. Now, the process to apply for that is very simple. All they really have to do is apply online, and then they pull a 4506, which is a tax transcript for the year 2018. So those businesses must have filed their taxes for 2018. After that, they'll get in line, and they'll get, more than likely, you're going to get approved for up to $2 million. The eligibility will determine on how much you owe, how much your payroll is. There's a series of questions, but you don't have to verify any of this, which is kind of bizarre. But it is available.
The process was super simple, and the payout was quick, like 7 days.
Yeah, it's a very right now, because of everything. It's a very streamlined process. So on top of that, the stimulus package will be also issuing out SBA loans a little bit more leniently. One of them, my daughter's sneaking by here. One of the things that they're talking about is issuing SBA loans without the guarantee fee, which can be a hefty amount of money. So depending on how much you're looking to borrow, so they're considering lifting the guarantee fee from those. The other thing, the disaster relief fund, you can borrow at 3.75%, which is an excellent rate. You don't have to pay on it for, I think, 6 to 8 months. And then I think if you use portion of it to sustain your payroll and you can prove that, then part of that money is forgivable. So it's pretty crazy in a good way. So if there's a business out there looking to sustain or stay alive during this crisis, I would absolutely go to this website. You just have to Google it. Just put SBA disaster relief, and it'll put you right there to the website.
Awesome. So if you guys know like small business owners that are struggling and they haven't yet had a zombie riot that Amber will cover, tell them to go to that website.
Yeah.
Ted, what company are you with again? How can people get in contact with you if they have mortgage questions?
I'm with American Mortgage Network. I can be reached at 480-650-8602 or email me at Ted, my first name, Canto, CANTO.com.
Where are you located, Ted?
I'm sorry?
What town?
I'm in Arizona. I'm licensed in Arizona and California.
Oh, cool. Okay, that's good to know.
What about you, Amber? Where can people get a hold of you if they want to check their rates?
Yeah, absolutely. So we're in Tucson, but we are licensed for the entire state of Arizona. Our phone number is 520-881-8000, and you can text that as well. Easiest way to find our email address, because Farmers gives us a long, ridiculous email address, is just to go to yourtucsonagent.com, and that will redirect you to our website with all of our information.
Awesome. Thank you. And then for those of you who haven't met me before, because I know there's a couple of you on there, you can go to my website and I do monthly market updates for Scottsdale, Phoenix, and Cave Creek Carefree area. And that website is dustymartinrealtor.com, DUSTIMARTIN.com. And if you follow me or Ted or Amber here on Facebook, I will tell you right now that the videos are easier to get uploaded to Facebook and or YouTube. And so they don't always make it to my blog on my website. So before we go, any last questions, zombie related or not?
Farmers will cover your ammo that you buy for your zombie apocalypse prep.
Awesome. Good to know. All right, everybody, have a great day. Thanks for tuning in. Stay safe. If you need TP, let me know.
Thanks, everybody.
All right, bye.
All right, thank you.
Bye.
Thank you.